Kumar Karwa joins us now. Let's take our conversation forward to understand what his view on the market is. KK, good morning. Thank you for joining us. I'm pinching myself.
Good morning.
Let me do it again. What happened on Friday versus if I compare today, it's a very, very crazy market. We fall hard and we come back fast.
I think, Nikunj, what we are is in the midst of a very strong bull market. And yes, then there are sometimes you have some macro reasons to take some money off the table. So yes, there were some fears about interest rates hardening, etc. globally and to some extent even locally. And that was a reason for money market investors to take some money off the table, coupled obviously with some aggressive FPI selling. Also, maybe it was some ETF redemptions, etc. But if you look at over the last 2 months, there have been outflows from many of the emerging markets, but we have been beneficiaries of very strong inflows. So you'll always have this continuous tussle between liquidity versus valuations. And sometimes maybe the liquidity part of the segment wins. But over a longer term, I think valuations is what is very important. And I still believe that analysts are behind the curve. We have seen the kind of upgrades even post the Q3 numbers. So my take is that as long as analysts are behind the curve, we continue to remain positive and bullish. The markets have not yet discounted the future. So we will have these bouts of selling in bit sometimes, but I think it's time to just stay invested in your chosen stocks and sectors.
Fair point. They say markets always look forward, which is that if there is bad news which is coming in the world, markets will move in advance, and if good news is coming, markets will anticipate that. While everybody is confident that things are looking up, when the actual number and the earnings upgrade will start kicking in, don't you think markets would say, look, we've already moved up in anticipation of this earnings recovery, why should it go higher?
Absolutely, I agree with you. That's what I said, that so far the analysts are behind the curve. So we are seeing a lot of upgrades which are still coming in, which means that the market has not yet discounted the kind of upside potential that various stocks have. And that's the reason why post the results also we have seen the markets holding out reasonably well. The day the analysts are not in a position to upgrade, which means that they have already captured and which means that the market has already captured the upside, then you could possibly see consolidation. But also I think we need to understand that in terms of, it's all about your time horizon. So in the short term that you could possibly see some consolidation, but sectors and stocks which have a lot of tailwinds, they will continue to deliver. My take also is that, we are in the midst of a very big bull run, and investors should, you talked about macros. My point is that it's good to know about macros, but ultimately what matters is the individual stocks that you own and how they are able to deliver or how they are impacted. So we have seen that whenever investors have taken too much of consideration of macros and divested of their stocks, I think it has been injurious to their portfolio health. So that's my humble submission, that yes, we need to be aware of the macros, but finally what matters is the fundamentals of each and every stock or sector that you own.
Are you convinced about what action and excitement we've seen in the PSU space, that the action and excitement is here? Is the rally in PSUs more like a deep swell or a secular bull run?
As far as public sector units are concerned, there can never be a secular bull run per se, because at the end of the day, the ownership structures are not totally aligned. The intentions of the majority owner, which is the government, can never be in sync with what the minority shareholders require. They have various social objectives. But having said that, currently what we are seeing is that there are so much talks about divestment, strategic or even otherwise, and the monetization of many of these assets. Now, there is an opportunity obviously in some of these companies which will get privatized. We have seen the success that the likes of Hindustan Zinc, etc. have seen over the years once they were privatized. So in terms of operational efficiencies, shareholder wealth creation, that's a big opportunity. So now I think, yes, we have seen a massive run up in many of the PSU stocks. they hold a lot of value. So there we will have to differentiate among the various PSU stocks in various buckets. So some of them which will possibly get privatized, yes, there would be investors who would be looking to invest in anticipation of privatization, or maybe even after that once the deals are concluded. And the others where there is a lot of value, where I think the market is happy to look at value and it is not as narrow as it was maybe a few years ago. And there is a kind of mean reversion happening where markets are willing to give it the fair value, or at least closer to fair value than what the markets have been giving. So if you look at PSUs, yes, from a last 3 to 6 month perspective, or maybe even a 1 year perspective, they have given good returns. But over a 3 to 5 year period, I think they have still destroyed a lot of wealth. So there's a lot of catch up that these PSUs can do. As far as the public sector banks are concerned, yes, there are some opportunities and there are tailwinds in the sector. It's all about the ability of many of these banks to deliver on credit growth, which is very important. And there could be some opportunities in a few banks which are expected to be privatized in the going next 12 to 24 months.
Krishna, we touched upon this being a bull market, and we've seen that every time there's even the remotest pullback or a scary Friday, we come back stronger. I want to get a sense from you on, the sectoral layout. I mean, we spoke about the shift towards cyclicals. Do you see that as a strong enough play now going forward? Do you feel that within this market there's actually enough to choose from, and maybe a portfolio should be more balanced? Because the rotation hasn't been, while there has been a rebounding in terms of a deeper focus on cyclicals, there still seems to be enough that's going on even in an IT, a pharma, and some of the so-called defensive plays even now.
When you mentioned cyclicals, my take is that investors need to be differentiating between the domestic cyclicals versus the global cyclicals. And I would be very, very wary and in terms of investing in global cyclicals, namely the metals, etc., because there the factors which can impact the commodity prices and the attendant stock prices are far too many. And there for an average investor to make money, I think is very challenging. But as far as domestic cyclicals are concerned, and I would also take banks in that category, I think with the GDP rebounding and expected to be very strong in the next few years. So that domestic cyclicals continue to offer opportunities. Now, whether it be in terms of the banks, or it could also be to some extent the auto companies or even the cement companies, they offer good opportunities for investors to invest in. Now, coming back to portfolio construct, yes, I think it's better to have a reasonably balanced portfolio. In terms of IT, yes, we continue to remain bullish on the IT sector, looking at the tailwinds that the sector is enjoying and the visibility that many of these companies have for the next 2, 3, 4 years. And balance sheets and conversion of profits, EBITDA into profits is very high for IT companies. So you will continue to see bouts of consolidation where some of these sectors or stocks would possibly be moving sideways or maybe some corrections. But it makes sense to have a balanced portfolio approach. I think investors in this bull market, or for that matter, any bull market, needs to be very cognizant of the kind of stocks that are in the portfolio, which means are they going lower down the curve in terms of management capabilities, quality, and long-term track record. So the temptation to weaken their portfolio to earn higher returns, that should be very much kept under control. And secondly, it's very tempting for investors in bull market to buy into 3-year, 5-year, 7-year stories, which may not deliver or which could be a lot of back-ended. I think investors in that euphoria tend to invest in those kind of companies and then they turn out disappointed. I think these are the two things that one should be careful of and use the bull market to lighten from stocks which are basically weak, but markets are giving you an opportunity to exit. So that's the trick, which is stay in a balanced portfolio and just ensure that the quality of the portfolio doesn't weaken.
Do you feel that there is a risk to the fund flows that are right now pouring into emerging markets on the back of whatever we see happening globally and what we saw last week with the yields, causing a little bit of fear there? Given that the domestic growth story is intact and looking strong, and India has been looking like a preferred play within the EM basket. But if there are any jitters on the global front?
Yes, there would be. I mean, there is no reason for flows to be as robust as they have been, and there can be periods where there could be some outflows, etc., and we should be prepared for that. I don't think so that we can expect a straight line inflows. There will be times when, and yes, we have already seen that when interest rates have hardened overseas, and we have seen some kind of outflows already. And even now, I think that the momentum which was there maybe in Jan, Feb, I think now we're possibly seeing a tempering of that momentum. And we should be prepared for these kind of jitters or outflows, etc. So there is no doubt about it. But I think from a domestic investors' perspective, we are seeing that so far the domestic mutual funds have seen a reasonably aggressive amount of outflows. Possibly, you could possibly see that in the next few months, maybe that should even out and should become neutral or maybe hopefully positive in the coming months. So I think why only look at global flows? That's one part. But what about the domestic flows, the domestic institutional flows? Even if that turns neutral, that's a good positive. And if it turns positive, then it's always better. So I think flows are important. But as I said in the beginning, flows can drive your markets up to a point. Ultimately, it's all about the valuations and the growth that the companies deliver. And in the longer run, I think the valuations and growth outperforms the short-term flows or outflows.
Valuation comfort.
Yeah.
KK, where do you still find valuation comfort in the market?
See, as I said, I think many of the banks, I think the valuations are still very, very reasonable for the growth opportunities that many of these banks offer. So I think there the valuations are very, very reasonable. Some of the auto companies which have shown a massive turnaround in terms of their sales, etc., be it the commercial vehicle segment or even the local passenger vehicle segment and their overseas business. So that's one segment where there is a lot of comfort as far as valuations are concerned. Then there's the tractor major which has announced a lot of restructuring as far as capital allocation is concerned. I think that's an opportunity that is still available. And my sense is that no doubt we have seen a decent amount of uptick in the developers, the real estate developers. But from a medium-term perspective, that is one segment where there is a lot of value still available for investors. We are coming out of maybe a 7-8 year kind of a cycle, and we've just seen the last 6 months of improvement. But from a next 2-3 year perspective, that's the segment which should deliver a reasonably good amount of returns. But I would still say that from a more than a sectoral perspective, investors should be looking at stocks from a bottoms-up perspective and try to invest amongst the top 2-3 companies in any sector. I think that would be a much better way of investing than trying to find value. And as I said in the beginning also, that public sector units, there is a lot of momentum which is there, and there is a lot of value in some of those public sector units even now. So I'm not a great advocate of investing in them from a 3-5 year perspective, but from a short term, which means a few years perspective, there could be some opportunities to invest in some of these public sector units also. And not only from a strategic divestment perspective, but the sheer value that many of these companies offer.
Sure. KK, on the subject of autos, though, while I completely get your point in as to how there are spaces which are still looking attractive and there is valuation comfort, tactically, is a better way to play the entire auto rebound is via ancillaries, or would you say no, the momentum seems to be favoring the PVs and CVs, wherein they're the last in the leg of the auto revival, and that's where you need to be put in?
I think you can have a balanced approach, which is obviously you invest in the OEM itself, but investing in a few of the ancillaries also could be an opportunity, because many of these ancillaries are not only catering to the domestic market, but they are global in nature in terms of their export potential. So even from a PLI perspective, there could be a massive opportunity in many of these ancillaries which have a lot of global presence and ability to manufacture and export. So from a portfolio perspective, having a direct OEM exposure plus a few of these ancillaries could work out. And the breadth of the opportunity as far as ancillaries are concerned, and many of them, the size that they have achieved, size and scale, is phenomenal. So there is a case to look at ancillaries too.
Okay, KK, great to have you on the show. Thank you so much for taking the time out and joining in today.